Support, resistance, and fractals. When I show dialogue like this, you can simply read through it, and because I'm going to be covering it in the dialogue in any event. When we look at a chart, and we just have a chart sitting before us, and we see where price currently is, which is on the far right hand side of the chart, then when we look back in time, we're going to see very distinct price points at which the market decided to take a turn. For example, these specific price points above market price are called resistance points. And what that means, quite simply, is that at this specific point in time, the market decided that it was unwilling to go beyond that specific price point, or there was a reason why the market was unwilling to go beyond that specific price point. Therefore, what it does is it creates a level of resistance as determined by the market at that time. And these are going to be important reference levels or reference points to us in the future, as they are for the entire market indeed, as we're going to talk about in more detail. And if we have market price and very distinct price levels below market price, these are levels of support. And these are, again, are distinct levels at which the market was unwilling to trade below at that given time. And these levels are clearly denoted back in time. When we look at a chart like this, we will see different time frames. For example, this one is a Euro US dollar 60-minute time frame. And we will see this on different time frames. And the point that I want to make is that the higher the time frame that the level of support or resistance is established at, the more profound or the more impactful it is on the market, or the more distinct it was of a price at that time, and will be carried into the future, and definitely will be acknowledged and respected at some point in time in the future. For example, levels of resistance and support on monthly charts, weekly, and daily charts. The higher time frames are more distinct than the ones on the smaller time frames, like the tick chart, the 5-minute and 15-minute, and so forth. But support and resistance, distinct support and resistance levels, will be established on each of the time frames, as we'll see. When we look at a chart, we want to pick out the distinct price cycles, or price, also called price swings, and we're going to use that term interchangeably as we proceed through this course. And the price cycles, we want to look for market to be making highs and lows, and sometimes they'll make higher highs and higher lows, and sometimes they won't. Price will simply consolidate. But it's important that we identify the distinct levels of resistance and support, whether we are trending or whether price is moving sideways. Here's an example of price cycles. For example, we take a high and a low and a high and a low. These are simply a price cycle where price moved from this low, it trended up, established a very distinct high point, moved down, established a distinct low point and high point and low point, and so forth. We were trending, now we're consolidating, and trending again, and now reversing. It's absolutely critical that when you look at a chart, you can clearly distinguish and point out the distinct high and low points on the chart, because these price swings are going to become imperative to our analysis in the future when we start to trade using Fibonacci. Here on this British pound daily chart, we see that price has moved from this low to this high, very distinct, to this low, and then there are some micro highs and lows in between, and then we go to again a very distinct high and a low, and then a high point of this consolidation, and a low. But in the interim, we also have micro lows and highs within this consolidation. But we have price cycles inside of price cycles.